The Middle East is once again at the center of global tensions, and this time, it's the escalating conflict between Israel and Iran. But, what does this mean for you, especially if you're an investor in the Indian market? Stay tuned as we dive deep into how this geopolitical conflict could impact the Indian economy and stock market, and more importantly, how you can invest wisely during this volatile period to build long-term wealth. So watch till the end if you are serious about building your wealth. Hey everyone, welcome back to the channel. Today, we're discussing a hot topic dominating the news cycle, the ongoing conflict between Israel and Iran. It's already affecting global oil prices and stock markets, but what does this mean for the Indian economy? And, how can you as an investor navigate these turbulent times to potentially grow your wealth? Let's break it down. First, let's talk about oil, the lifeblood of the global economy. India imports over 80% of its crude oil, and the Middle East is a major supplier. Any disruption in that supply chain due to escalating tensions means oil prices surge. As oil prices increase, India's import bills also rise, leading to higher inflation. This means increased costs for businesses in industries like aviation, transport, and manufacturing, which rely heavily on fuel. But more importantly, for the common person, this results in higher prices for goods and services, think fuel, groceries, transportation costs, and more. Inflationary pressures due to rising oil prices could slow down the Indian economy's recovery, affecting both businesses and consumers alike. Now, rising oil prices don't just hit inflation, they also impact the value of the Indian rupee. Since oil is priced in dollars, a higher import bill means more dollars flowing out of India, weakening the rupee. A depreciating rupee puts more strain on the economy. Import-dependent sectors, like technology and electronics, may see higher input costs, leading to reduced profit margins. However, exporters, especially in IT and textiles, could benefit from a weaker rupee, as their products become cheaper in international markets. So how does the stock market react to all this? Typically, geopolitical tensions lead to volatility across global markets. The Indian stock market is no exception, with sectors like energy, aviation, and manufacturing taking a hit due to rising fuel prices and costs. Energy companies will struggle with fluctuating oil prices, while sectors like consumer goods and banking could face challenges due to inflation. But don't worry, it's not all bad news. In fact, there are some sectors that tend to perform well in these situations, which brings us to the next part. While there are challenges, this situation also opens up some excellent investment opportunities. Let's dive deeper into which sectors you can explore to potentially grow your wealth during these times. 1. Energy stocks. With the surge in oil prices, energy stocks like ONGC and Reliance could see short-term gains. Consider companies involved in oil exploration and natural gas, which may benefit from price increases. 2. Gold and precious metals. In times of conflict, investors move towards safe haven assets like gold. Adding gold and silver to your portfolio through ETFs, sovereign bonds, or even physical assets can protect against market volatility. Historically, gold prices rise when the stock market falls due to crises. 3. Defense and aerospace stocks. With tensions high, governments often increase defense spending. Companies like Bharat Electronics and Hindustan Aeronautics could see a boost in demand for military equipment. These stocks are positioned to perform well during times of geopolitical uncertainty. 4. Pharmaceuticals. Pharmaceutical stocks like Sun Pharma and Cipla tend to be resilient in volatile times, as healthcare is a sector that continues to thrive regardless of economic conditions. Adding pharma to your portfolio could offer stability. 5. Information technology. IT companies like Infosys, TCS, and Wipro are globally diversified, making them less vulnerable to domestic market shocks. They also benefit from a weak rupee as a major portion of their revenue comes from overseas clients. 6. Agriculture and FMCG. Sectors like agriculture and FMCG, fast-moving consumer goods, are considered safe bets during inflationary periods. Stocks like HUL, Nestle India, and ITC provide essential goods and are less likely to be impacted by rising oil prices. While market volatility can be stressful, it's important to remember that volatility also presents opportunities. Let's discuss some strategies to help you invest wisely and come out stronger. 1. Diversify your portfolio. The golden rule of investing is diversification. Spread your investments across sectors like IT, pharmaceuticals, FMCG, and commodities like gold. This reduces your exposure to risk from any one sector being hit by oil price fluctuations. 2. Look for value in large-cap stocks. During periods of high volatility, large-cap stocks tend to offer stability. Blue-chip companies like HDFC Bank, Reliance, and Infosys have strong balance sheets and are more resilient to market shocks. These are safer bets for long-term growth. 3. Consider commodities and real assets. Beyond stocks, consider investing in commodities like gold and silver, which act as a hedge against inflation. Real estate, too, can provide a more stable, long-term return that is less volatile compared to stocks. 4. Avoid panic selling. Think long-term. One of the worst mistakes you can make during volatile times is panic selling. Historically, markets recover from geopolitical events. Instead of reacting emotionally, hold on to fundamentally strong stocks and trust the long-term growth of the Indian economy. 5. Dollar cost averaging, DCA. One of the best strategies to navigate a volatile market is dollar cost averaging. This means investing a fixed amount at regular intervals, regardless of market conditions. By doing this, you buy more shares when prices are low and fewer when prices are high, averaging out your cost. 6. Increase exposure to fixed income instruments. Bonds and fixed income instruments can provide much-needed stability. Consider government bonds, corporate bonds, or debt mutual funds. These can give you steady returns while protecting you from the stock market's ups and downs. 7. Stay informed and agile. Stay updated with the latest news and financial insights, but avoid knee-jerk reactions. Having a well-thought-out plan and staying agile allows you to adjust your portfolio without panic selling. Use tools like stop-loss orders to protect your investments. 8. Reassess your risk tolerance. Volatile times are a great opportunity to reassess your risk tolerance. If you find the market fluctuations too stressful, consider shifting towards more conservative investments. Your financial goals and comfort level should always guide your decisions. In summary, while the Israel-Iran conflict may cause short-term disruptions, with rising oil prices and market volatility, smart investors can turn this challenge into an opportunity. By diversifying your portfolio, investing in safer sectors, and focusing on long-term growth, you can navigate these turbulent times and potentially come out wealthier. Remember, the key to successful investing during volatile times is staying informed, diversifying, and remaining patient. What do you think of the current market trends? Let me know in the comments below, and don't forget to like, subscribe, and hit that notification bell for more financial insights and strategies to help you grow your wealth.